All right. So once you maximize your Roth IRA and HSA contributions, the next step is to max out your employee retirement above whatever you contribute to get your employer match back in step 3 of my checklist. In 2023, the maximum personal contribution limit is $22,500. So if you're already contributing to the employer match, then you want to go above and beyond and invest up to the maximum. Because with a 7% average annual return and a $500 contribution increase every year, you're going to reach $1 million just in your 401k in 18 years. If you're self-employed with a solo 401k, let's say you're a self-employed like me, your limit is a lot higher because you can do both employee and employer contributions. And depending on your salary, you may already be saving about 20 or 25% of your gross income towards your retirement. While I encourage you to maximize your retirement contributions every year, you want to make sure that you don't become cash poor and have too much in retirement. So make sure to have a balance between your cash savings and retirement investing. And the next step is to achieve a 50% savings rate. You can accomplish this by contributing more to your retirement, opening a taxable investment account, a 529 or UTMA for your kids. You also want to use your gross income to calculate your savings rate because your after-tax income fluctuates based on the federal or state income tax rates. For example, if you make $150,000 a year and save $75,000 a year, then that's a 50% savings rate, right? And here's some additional tips that to save half of your income. If you're in a dual income household, try to save one income and spend the other one. You can also open FSAs or flexible spending accounts that could lower your taxable income. The common ones are the healthcare FSA, dependent care FSA, and the limited purpose healthcare FSA. And if you have children, then consider opening a 529 college savings plan to save for their K-12 or college expenses. And laws changed on the 529 a while ago. You don't have to use the 529 on their 4-year degree anymore. You can use it for their K-12 if you want to send them to private college. Just check with your state and make sure you have that eligibility. And you can also gift your children by opening UTMA or UGMA accounts. My daughter has a UTMA account and a 529. So 529 is going to be more for her books, educational expenses, right? UTMA is going to be used for, say, a deposit for her apartment or to buy a car or buy something else to kind of help her get started in whatever life that she chooses to do. She goes to college. She doesn't just rely on the 529, but she can also rely on the UGMA. So check with your state. It's this one right here, UTMA or UGMA to use it. And flexible spending account, you can't carry over the balance every year like the HSA. So this is just one way to save gross income, and then you can calculate the net net savings rate. Sorry, not the income. All right. So, but most people increase their savings rate by investing in taxable investment accounts, so they can have access to them during their early retirement, right? So I talked about the dividend investing strategy in my last live stream. And you can check that out on my live stream playlist. You can do the mega backdoor Roth with your 401k if your employer offers what's called the in-plan rollovers or in-service withdrawals. That process is pretty complicated, but you can get with your HR and the 401k broker to find out if they have a process in place. So instead of just doing the $22,500 for the personal contribution, you can also, you can roll that right into the Roth IRA. Again, that process, I have a video on that. I think I made it about a year and a half ago. You can check it out. Just type in mega backdoor Roth fireside chat, and then you should be able to find it. And step 9 of the FIRE checklist is to build generational wealth. You can arguably put steps 8 and 9 together, but I wanted to separate them for several reasons. When you're on this step, you're most likely close to or in the financial independence stage. What my wife and I are building now can be passed down from our generation to the next generation. Generational wealth can be our cash, investment funds, properties, and businesses, right? If I'm done with this business, I can pass it down to my child or grandchild if they want to. We want to create a legacy that my previous generations couldn't do in the past. And this is the stage to create estate planning with your spouse. And it doesn't matter how old you are. You should always have a will in place in case something devastating happens to you. If you're a high net worth individual, I would say beginning with $500,000, you should consider forming a trust to have more control of your assets in the event of your death. And you should designate beneficiaries for every bank account, investment account, and any properties you have under your name. The last thing you want is for your family to fight over your properties in probate after you pass away, or you forgot to update your beneficiaries. You still have your ex-wife or your ex-husband on your beneficiary, and you suddenly pass away. Now your ex gets, your Roth IRA, and you're just going to end up pissing off your family members, right? That's something that you don't want your family members to go through. And what I also encourage you to do is really to educate your kids or grandkids about financial education. And you don't have to wait until you're on step 8 or 9 of the fire checklist. You can share some of the financial mistakes that you made in the past and how you overcome those mistakes. Teach them how to be generous, like you are, to the community. And by step 6, you can choose to set aside some money for charities or the community. You can even do a random act of kindness without asking for anything in return, right? But I recommend that you wait until you have a fully funded emergency fund in step 5, before you start donating to charities. You want to make sure that your finances are in order before you're generous to others. Okay. So this is I could argue that you can actually start doing the will and trust if you're like on step 6 and step 7. And typically if you have like over $500,000 in net worth, start doing the umbrella insurance. So if you get sued for more money, you're protected with the umbrella insurance. The final step is to pay off the mortgage. And this step can be in the earlier step if you're close to your retirement age. So before you start paying off your mortgage, you should consider your age, risk management, and your overall net worth. And I've had this question from one of my clients in the past, whether he should pay off his personal loan or mortgage loan first. And I know what most of you guys would say, well, pay off your personal loan first. And if you have any debt other than your mortgage, you should pay off those things first, right? If you don't have enough saved in your retirement, you should prioritize your retirement first. This is, again, where you assess your net worth so that you don't have too much in real estate while you don't have enough in retirement, right? And next one is to assess your age and risks. If I'm in my 50s or 60s, I would pay extra on my primary home mortgage while I'm investing in retirement. While I'm in my 20s, 30s, or 40s, I would prioritize investing before paying down the mortgage, because time is on my side to allow my retirement investments to grow exponentially. I talked extensively in the last video I did on how to decide whether you should pay down your mortgage or not. I'll put that link in the description below as well. You should definitely consider those 3 things: age, risk management, and your overall net worth, so you're not too heavy in real estate and not having enough in your retirement. And these are the 10 steps of the financial independence checklist that I have been following since 2017 so that I can retire early.